All right, welcome back, everybody. This is our final panel of the forum. This one is entitled Rebuilding the Future, Insurance Sector's Role in Infrastructure. Our moderator is Anita Fox, Director from the Michigan Department of Insurance and Financial Services. Director Fox will be joined by panelists Jim Hempstead, Managing Director, Moody's Investor Service, Martin Mair, Vice President, Government Relations, MetLife, and Jean-Gabriel, Pierre, Head of Investment Strategy and Alternatives at AXA XL. So with that, please join me in welcoming this panel.
Thank you, Commissioner Anderson, for the nice welcome and the opportunity to back cleanup. It is a little daunting to follow Director Cameron, after he's been a politician for so many years, but I'm going to do my best. I'd like to welcome our audience to Rebuilding the Future, Insurance Sector's Role in Infrastructure, the final panel of this very interesting NAIC International Insurance Forum that we've had so far. So when most of us think of infrastructure, we think of big machines, road building, building towers, and we know it's one of the most important aspects of our daily life, but we also know that it remains grossly underfunded, and that's certainly at the forefront in many of our states, discussing how to rebuild infrastructure. We know it has been a priority for the federal government as well. But we also know that necessary infrastructure has really changed and grown over the years here. It's no longer simply those big hard projects, but technological infrastructure has become equally, if not more important. So as we see these funding gaps, we now look to institutional investors, including insurance companies, and wonder how those companies are seeing infrastructure investment as a long-term investment and their ability to help the societal need in filling that funding gap, either through direct investment, infrastructure funds, or public-private partnerships, among others. So we do have a lot to talk about today and really keep people engaged just with this last sentence. And we want to allow as much time as possible for discussion. So all panelists' bios will be in the program and online. And if you could refer to those to learn about the distinguished backgrounds of our guests, that would be great. And so without further ado, let me welcome James Martin and Jean-Gabriel to our panel. So thank you, gentlemen, for being here. I'd like to start out by, we talk a lot about infrastructure, and I want to get your thoughts about why it is an attractive and increasingly more so investment option for large pools of capital and how that asset class has evolved. On the micro level, we hear when inflation is high, good time to get into real estate, when the market is less secure. How about these recent macro trends like inflation, supply chain disruption affected the attractiveness of this kind of asset class? Does it typically increase or reduce investment risk in investment portfolios? So let me start with you, Jean-Gabriel. Tell us what your thought is about that.
Thank you, Director, and thank you for having me. I would say that adding infrastructure in a portfolio would generally optimize the risk-return profile for several reasons which are specific to the asset class. First, it's an asset class that is less sensitive to GDP than typical corporate or equity risk. And that's because a large part of it relates to critical infrastructure for society. So if we think about in a downturn, people will still need to drive, we still need to heat their homes, and we'll still need to communicate with internet or their cellular. So because of this, infrastructure assets have a relatively low correlation to other risky assets, and that's beneficial to the risk-return profile of the portfolio. They're also partially indexed to inflation contractually. Valuations have been historically relatively stable, so I would say it's a lower volatile asset class compared to public or even private equities. And on top of this, infrastructure assets generate a relatively stable yield, which insurers generally like to pay for their policyholders or even shareholders.
Right.
Among the recent trends, I would mention digitalization. It started in the 90s, but it's still going on with new services being developed, which require higher speed. So that's about fiber networks, about cellular networks, right. Telecom towers, etc. Decarbonization and energy transition is obviously a trend with massive investment needs, but resilience of the existing infrastructure is also an important theme, and we have some examples of storms or right. hurricane affecting the infrastructure. In terms of challenges, obviously we discussed the Ukraine war and more generally geopolitical tensions that have been that have pushed governments to reshuffle to some extent their energy sourcing strategies, and it has some implication, notably for LNG and building more infrastructure. I would mention also the inflation, the high inflation, supply chain issues, and tight labor market, especially for skilled labor, which is impacting new projects, greenfield projects. And lastly, the high interest rate environment, which is also challenging valuations.
So you obviously raised some issues that are very much on our forefront here: liquidity, resiliency. So I think that's a really interesting perspective. What can you add here to this, Martin?
Yeah, good morning, everyone, and thank you, Director Fox. If you listen carefully, I'm going to basically repeat everything that Jean-Gabriel just said, but just in a much less romantic tone.
Yes.
So I think there are basically three reasons why an infrastructure asset is an attractive asset for an insurance portfolio, and all three of these tend to reduce the balance sheet volatility of an insurance company. The first two relate to credit. So your typical insurance company portfolio has a concentration in unsecured corporate credit, and overseas, maybe a concentration in sovereign credits. So if you can add an asset class into that, which is a secured, non-corporate credit, you are achieving a diversification benefit. And for those of you in the investments function, you know that diversification is one of the few free lunches that are out there. In other words, you can maintain the same portfolio return, reduce the portfolio risk. Right. So it's an absolute kind of a good, and infrastructure serves a valuable purpose there. Now it's also been demonstrated over and over again, and Jim is the real expert on this one, but that infrastructure assets, infrastructure debt in particular, has a lower investment risk than your typical corporate credit. And Jim will go into more gory detail in terms of why that is. But even on a standalone basis, the credit risk is generally lower in infrastructure assets. And the third one relates to the particular characteristics of insurance portfolios, which are often, particularly for life insurance companies, you have long-term liabilities. And you're always on the lookout for long-term assets, particularly those that offer some kind of a spread above treasuries. And infrastructure generally serves that purpose because these are kind of long-term projects. So you end up balancing the asset liability management of your portfolio better with infrastructure assets. So as a whole, for those three, and all three of those reasons are very powerful reasons, the infrastructure is generally an attractive asset for insurance portfolios.
Well, with this room, you had us at lower risk. So that was a good place to start. No pressure, Jim. You've just been identified as the expert here, so let's hear what you have to say.
Yeah, I usually try to set the expectations low to step over that bar. But, well, so let's talk about that. So when we look at infrastructure at Moody's, I'm at Moody's Investor Service. We're a credit rating agency. And we look at the infrastructure investments, and what we see is a lot of contracted cash flows, unfettered access to capital markets, things like that. And when we run our default studies, we look at infrastructure default, which we define, as we define it, it's the utilities, electric, gas, water, wastewater, midstream, airports, seaports, toll roads, and then a lot of the public-private partnerships that we'll talk about and other project financing structures. it has a lower default rate than non-financial corporates. So for your diversification scenario, non-financial corporates, the 10-year cumulative default rate for non-financial corporates is about 14%, whereas for infrastructure, it's a little over 3%. Wow. And we could break that out and say, what's power? Power is about 5%, and oil and gas is about 7%. So we have data and analytics that we could show, and this stuff goes back to 1983. There's 10,000 different projects in here that shows this. From a recovery basis, the average recovery rate's around 80%, which is very similar to non-financial corporate recovery rates, but the distribution is different. So 60% of the projects that run into problems, infrastructure projects that run into problems, get 100% recovery because they work it out, because there is access. There's ability to tweak the contracts and the off-taker agreements. And then you have that tail risk where it's very low versus the non-financial corporates that you have an 80% recovery rate as well. So for these reasons, we look at the infrastructure asset class as a higher rating quality, lower default rate, and most of our ratings in our portfolio are investment grade. Now, yesterday we rated a LNG export terminal, two projects for Venture Global. One of them is kind of running, and one of them is under construction, and that came out with a single B1 rating is what we call it. And I haven't heard what the appetite was, but all of the offerings that we are rating are coming in at 5, 6, 7, 8 times oversubscribed, which just tells us that this is a great time to be looking for capital in the infrastructure space.
So we know that infrastructure is a huge issue and demand is high for that, and we're hearing that it's a great investment, but we also hear about the gap. So the American Society of Civil Engineers estimates that a $2.6 trillion infrastructure gap in the United States. So why do these gaps occur? And you touched on this a bit about the different sectors. Where do the majority of these infrastructure gaps lie? Is it municipal projects like roads, bridges, rails? Is it more commercial products like broadband, healthcare, et cetera? So why the disconnect between this great investment, this great need, and yet we have a huge gap? I'll start with you this time, Jim.
So I'll tee it up. When we look at the gap, we see a lot of definitional issues around what is the gap. So however you want to think about the gap, you have to define it. What we see is that even with low scores and an infrastructure gap, the assets are still working. People are moving, they're getting from A to B, whatever the product is. And so we see differences in how that gets applied regionally. And so is there a political element in it? Maybe. Most of the projects that we rate have incorporated in there a lot of maintenance and renovation type cost expectations and expenses that they expect to do over the life of the project. And so really what the gap is there a willingness to make that happen? And then how do you keep up with the demand growth or the other growth that you're looking for? Where would that come from? So we're seeing gaps more from a definitional perspective as opposed to an actual, assets on the ground or assets in the ground.
And is that true both U.S. and globally?
Globally, absolutely.
Okay. Interesting. How about you, Martin? What's your thought about that?
Yeah, I'm just going to narrow the question down to if infrastructure assets are so attractive for insurance portfolios, why is there a gap in terms of why aren't insurance portfolios invested more in infrastructure assets?
Good
right?
question. You want to sit over here?
Maybe for this audience. So there are a couple of reasons for that. I think actually, surprisingly, the most significant issue may be that infrastructure debt has a limited availability to insurance companies because they're not available, many of them are not available in the public markets. In other words, there is a very large public sector investment in infrastructure, right, which basically takes a lot of that the direct debt, if you will, off of the public markets. to begin with, and then if it is financed via, let's say, a municipal route, then that's often issued as municipal debt, which is often tax advantaged, and there's only a kind of a limited portion of the investor universe that's able to take full advantage of that tax benefit.
Right.
So for example, it's pretty common knowledge, I think, that property casualty companies are much heavier investors in tax advantaged debt than life companies. They're better able to kind of harvest that advantage than life companies. So for a life company, even if a attractive investment opportunity comes, but it comes with this tax angle that they can't really take full advantage of, that for a life company might take it off of the efficient frontier that it otherwise would be on, right? So, so there's actually a significant limitation, particularly for a life company, in terms of getting access, to that debt, which is unfortunate.
Sounds like the life insurance industry needs to be talking to the policymakers who are coming through with that.
So, we'd love to invest more in infrastructure if the right opportunities existed. And so I think that'll get to the later discussion on public-private partnerships. But I think that's a major issue. Another issue is that from time to time, at least, a lot of infrastructure assets are either kind of idiosyncratic or kind of maybe difficult to rate, right? And insurance companies need to have that rating in order to map to a capital factor, and again, to get back to that efficient frontier. So that can sometimes be a challenge as well.
Jean-Gabriel, your thoughts?
I would just add on the traditional mobility infrastructure, and I was discussing that with my underwriting colleagues, because we also insure that type of projects, that they have seen them picking up, especially with the Infrastructure Act, which was aimed at pushing those investments, but it has taken time. So we can see that coming, but the launch of those projects will probably accelerate in the next couple of years.
So I'm going to weave in a couple of questions from the Slido here. So there's two of them that are sort of related. One says, should ESG goals factor into infrastructure investment? And the other said, if industry priorities are directing infrastructure investment decisions, how do we know that they align with the common good? So I guess, should we be worrying about whether they align with the common good? And if they do, if that's true, then how do we know what is the common good and that they're aligning with that? Who wants to be the first one to dive into that?
I'll jump into that one. So at Moody's, we have been assigning ESG scores two ways on all of the rated entities in our portfolio. The first one are what we call them issuers. We don't say companies or projects, we say issuers because we do governments and stuff like that. Our issuer profile score is how risky are these various considerations. And so we've defined how we look at environmental risks. Is it carbon transition? Is it the physical effects of climate? Or is it water management? We define social and we define governance. And we have our various different definitions. This is how we apply it. And that's a rating methodology, which is the core document that all of our ratings are based on, is the rating methodology. So we have an ESG rating methodology. It's publicly available. It's been commented on. And we'll update it every now and then to fix it. That methodology is applied consistently across all of the asset classes that we rate. We don't care how green, clean, or virtuous the entity is. This is what I like to say. We don't care how many dolphins are saved and things like that. And it's not that we don't care. Our focus is on credit. Do you pay your debt back on time as promised? That's the heart of everything that we do. So from an ESG perspective, if you do things that help you with your credit, you're going to get a better score. Now, we rate, like I said, we rated an LNG facility, we rate gas pipelines, we rate oil and gas businesses, we rate prisons. So it's from a credit perspective, that's what we do. Is it for the common good? That's a good question. There was a prison that tried to get rated, raise some debt a couple of years ago. Maybe it was during the pandemic. I kind of forget right now. They ran into a problem with the marketplace, where the marketplace didn't want to give them the capital at the terms that they were willing to accept. That's different. And so we differentiate from that perspective. But on the common good question, that's another thing that's really hard for us as a credit rating agency to assess. And so I always think about all those pipeline projects that tried to come out of the Marcellus Shale and the Appalachia region. And you know, each one of them had a good reason. But when you put them all together, do you really need all that? And so the environmental people, the lobbyists, the environmentalists, they got in the way of that and made most of those projects go away. So that's what we were able to work on.
Perfect. Anyone else want to weigh in on that?
Go ahead.
I mean, it's touching on another question that we had discussed, green versus non-green investments. And you know, my thoughts echoes a lot what you just said. I think insurers will and should continue to primarily look at the risk return of the portfolio and try to optimize that net of diversification. And it calls for a balanced and a dynamic approach. So, but in any case, for instance, in the energy space, transition risks need to be recognized and measured and analyzed. And there are risks on both ways. If you think about it, investing on all new green technologies is probably too risky of a strategy. Right. Some of those technologies are not mature, or the economic ecosystem is not mature, for instance, in the case of hydrogen. On the other side, having a portfolio which is only, traditional energy assets is also risky, because in 10, 15 years, those are long, illiquid investments. And how will you exit those investments? I mean, we don't know. So I think insurers should stay focused on diversifying their portfolios. In terms of performance, some people are concerned, whether the performance is at the same level. I think a good mitigant of that is that most insurers go with third-party specialized asset managers, and you pay a performance fee to those managers, which is only based on the pure financial performance. Those managers will always be very incentivized to optimize the performance and not compromise.
We talked a little bit here. Did you want to add something there to that? Go ahead.
I think part of this relates to a kind of a definitional issue. I think of infrastructure really, I think it's helpful to think about infrastructure in two ways: in the traditional ways and in the kind of the newer expanded definition of infrastructure. So if you think of traditional, I call it economic infrastructure, talking about like transportation, telecommunications, water resources, waste management, telecommunications, maybe more recently kind of broadband, adding that in. I think that there's a pretty kind of a solid definition, and everybody accepts that as infrastructure. And there are really two positive or hallmarks associated with that traditional definition. The first is that there's incredible kind of bipartisan support, for that type of infrastructure. Find me a congressman or a senator who is not in favor of repairing roads kind of in their district or in their state, right? I mean, it's really, so it's really a bipartisan issue, which is, one reason that we saw the $1 trillion bill in late 2021. And the second part of that is that economic study after economic study shows that intelligent traditional infrastructure projects generate an economic multiplier effect in the economy. So in other words, if there's a busy road with lots of potholes, it needs to be repaired, it costs $1 million to repair the road, you do an economic study after that, and if you're really all-encompassing and you see, people are now showing up to work on time, right? And they're actually able to do their job during the day because they didn't have to deal with this road. People don't have to stay home and take their cars to the shop to repair, all the issues with it. Insurance companies have fewer claims on on automobiles. There's lower, mental stress because people don't have to, pull out their hair, getting to and from work, or even leisure activities. You add that up, and the benefits end up being 5-10 times, what the repair costs. And this is study after study. So and this cuts across, all groups in the economy. So it's hard to argue that traditional infrastructure is not a common good, and it's bipartisan, right? So I think a lot of and you can see why that creates a strong incentive for newer forms of infrastructure, whether it's green infrastructure, social infrastructure, to try to be associated with the traditional infrastructure and hope to carry those kind of tailwinds, right? So I think that's part of the issue about how broad is that definition of infrastructure to encompass those kind of fundamental issues.
I think we'll move on to some of those issues in a minute about public-private and about the whole environmental and that. But someone has asked this, just to clarify. So we heard here talking about how infrastructure investment can be good in the environment that we see now in terms of where money is. But there's a question that says, despite those inflation and other monetary characteristics, since money is no longer essentially free, as it has been for several years, do you think that will lead to a dip in infrastructure investment? That's kind of the flip side of it's sort of more inflation-proof. So anybody want to comment on that question?
I would say it's a question on expected returns. I think it's a fair question. It's also the same question for real estate. I would say that in the current environment, the repricing has been more rapid on the debt side, on the credit side. So on a relative value basis, debt looks more attractive than equity investments, I would say. And I believe that it will have to reprice to some extent to make the asset class still appealing against public assets, which are more simple to invest and that people know. And it was discussed as well in a panel yesterday with general investment topics. I think that's the case for infrastructure as well.
So it'll impact, it'll be part of the calculation of the risk and the return, but it won't necessarily see it go away. Is that kind of true?
Yeah, we're not seeing that at all. The project and infrastructure finance portfolio that I help manage, we have 100 analysts globally that rate $3.5 trillion worth of debt. We probably rate a little over $300 billion a year of new debt. And we see that number going up on average 5% a year for the next couple of years. It has been rising about 6 or 7% a year over the last couple of years, compound annual growth rate. But we're building. We're hiring more analysts. We're bringing more of the junior analysts up to speed on how to do project financing and how to do renewable energy projects, because we see a significant move in that. And when we meet with the big money, the private equity money, the hedge fund money, the long-term insurance company, and other asset owners, they're all increasing. Well, we think that they're all increasing their allocation towards infrastructure. Then it gets into how you want to define it and things like that.
Yeah, I just completely agree. I mean, you have to remember when rates go up, the yields on infrastructure assets also go up, right? So along with everything else. So, if anything, rates higher mean less investment in equticity and more in fixed income. So I wouldn't really expect any net decline in infrastructure attractability because of that.
And the costs go up. So the user fees or the revenue model or whatever that is will go up and rise with the cost of capital.
Right. That's, I think, was Jean-Gabriel's point as well. So let's talk about the many ways to invest in infrastructure. Historically, most infrastructure investments were in the debt space. Direct infrastructure investment is an asset class that's been typically for institutional investors. Municipal bonds have always been part of that space. Larger, more sophisticated investors, including insurance asset managers, are increasingly taking the road to more direct investment or taking over bank loans. So I want to ask you, how has direct investment performed compared to broader infrastructure fund approaches, and are there unique risks of this approach? And the sector should be thinking about, is one better than the other for insurers? So let me start with you, Jean-Gabriel.
Yes, so I would distinguish by instrument. So starting with public investment-grade debt, and in the US, it's also mostly municipal bonds and revenue bonds. Generally, investing direct is efficient, or it can be also a bespoke mandate with an asset managers, where the insurer can set some guidelines in terms of risk and control the level of risk and diversification. For private equity or private loans, it requires more resources to originate the asset, to structure, and to monitor the asset. So, and you still need to diversify in sector and geographies. So for those type of assets, I think it makes more sense to use funds. And of course, there is a cost with that, but this cost can be mitigated by doing co-investments. Generally, those funds offer their investors to co-invest on some projects, and they don't charge fees on co-investments. So you can gradually build some expertise by co-investing, and it helps to decrease your cost of investing. Regarding whether to set up a dedicated internal team, I would highlight the following points. It takes time to gather the relevant expertise and the relevant people. Talent retention is a key risk there, especially for a portfolio that you cannot liquidate, in a week. So that's something to be considered, and the corporate culture also is helping to retain people. And you need sufficient scale to maintain expertise in a broad range of technologies and get access to large deals, which generally are paying a premium. So that's also something to consider for setting up your proprietary team.
Anybody else want to weigh in on that?
One thing on like direct investment, the private capital side, transparency. There's a different level of transparency from our, we're not sure we have that transparency. The investment community might not have it, the investors have it. And then that also lends to the ability to structure a lot of these projects with covenant light. No one really had a lot of covenants recently, but as market conditions change, maybe covenants start to tighten up again. But the covenant light structures, the ability to do delayed draw stops and things of that nature really fits into that direct model well.
I just have a question. I mean, it almost sounds like this is a kind of a large company versus a small company issue. If there are like economies of scale in terms of building an internal team, is that what you're kind of seeing? Is that there's more direct with the larger individual companies and
it
more
seems
fund
intuitive,
structure
but I don't know if it's true.
Medium size or smaller?
Yes, for instance, at AXA, we have the internal asset manager, AXA IM. They have a dedicated team for direct investment in infrastructure. They manage about 15 billion in loans and equities. But we are also seeking to hire external managers, and there is another team which was also moved recently to the asset manager, which is selecting third-party managers to complement the expertise.
So let's turn to energy, because that's obviously been a topic that's come in. It's certainly a topic that's of interest to our listeners here. So the U.S. Is a massive producer and consumer of energy on both sides. And the policy research wing of the NEIC, the CIPR, published a report that notes that insurance industry investments in infrastructure are very, very heavily concentrated in oil and gas sector. And that's something you alluded to as well, kind of trying to balancing the old with the new. The transition to renewables will probably remain a global transition. It's something that we're seeing. And meanwhile, the existing energy infrastructure is a source of economic and national security that requires maintenance and investment. So how should insurers be thinking about balancing this greener investment with investments that are necessary to maintain a very important current energy infrastructure? And I think that's something that you alluded to, this mixture. So if you'd like to start us off there, Jean-Gabriel.
Yes, so obviously there are massive investment needs to deliver on, the net zero commitments that most developed countries have taken, including the US. But at the same time, you need to take care about the existing energy infrastructure because the transition will be gradual and will take a lot of time. And I think it's not a binary question. I mean, it's a complex question and obviously, political question. But there are an infinity of paths to transition, right? And the big question is, which paths will be realized. So I think insurers need, again, to consider this as recognize that there is this transition risk. There are risks on both sides, and that it needs to be monitored. And governments will continue to play a key role, right? So in the US, it's more through tax incentives and the Inflation Reduction Act. In Europe, it's more through direct carbon emissions regulations, which I think is also done in California. But overall, it will stay a very political topics. Governments will need, will stay very engaged, and insurers will have to adapt to, evolving policies.
Yeah, the political part is really important about that. Is this just another aspect of diversification also, right? Like diversifying your old energy, essentially, investment with the transitioning to what are more emerging technologies. Go ahead, Martin.
Yeah, I'll just say as the only non-expert on this panel, I'll take every opportunity I can to leverage. So I think the talk that we heard the first thing this morning on the Ukraine war, that really just changed the entire calculus of this discussion about whether we should be going. How quick should the transition be?
Right.
And I think it just changed the calculation just tremendously in terms of going to exactly what Jean-Gabriel said, is that we need to push on all fronts in order to, because the world is becoming increasingly less reliable in terms of having a globalized energy strategy, and that energy is essentially being used as a political weapon on that, and in that source, we just need to be able to source all the energy from whatever source that we can. So I think in many ways, if you think of that, that should be a great boon to renewables, because we need renewables as much as we need everything else just for energy security purposes. I think it's just the time to think more broadly about how we and our allies around the world can achieve that energy security in a more volatile political environment generally.
And maybe that touches on one of our questions here. Is greenwashing an issue with infrastructure investment?
I think it is an issue because green is a simple word, but the underlying reality is very complex. It's an engineering world where, I'm no expert either.
So I guess you're the only expert now, Jim.
For another 30 minutes?
31.
But I was meeting last week with some of those managers, which are supposed to be the experts. And,
right.
You get into very complex engineering issues. So sometimes to tell, what is green or not is not a straightforward question. So I think everyone, will need to increase their level of awareness at every level, and to be able to, and there is also a matter of standardization, and probably Europe has done, more work on that side with, defining the terminology, but it's also helping an industry, to discuss those matters and making sure there are clear definitions for, what is green, what is not green.
So greenwashing is an interesting topic, right? So there's a connotation associated with greenwashing that's a negative. And part of it is that it's marketing. So of course there's greenwashing going on, because if you can't slice and dice the numbers in some way, shape, or form to make your project or your company stand out as the top, you're probably not in the top 10. And so all the banks do that, all the underwriters do that, and all the companies do that. So they want to present themselves in the best possible light. And so you get this strange thing that's happening. So in Georgia recently, they want to change some of the rules on what biomass is. Is that greenwashing? You know, maybe, but that's the way they're going to define it, and then everybody can apply themselves to that particular way. So if you want to burn car tires and call yourself a biomass, you can do that, because they're going to change the definition of what that is. And as a rating agency, we're not going to ding anybody on that, but the energy transition component of it, you can't greenwash that. It's too big. And so the transition, it will be volatile, but everything that we are seeing, it's not as expensive as you think. And so there is a tendency to come up with really, really big numbers on what the energy transition is going to be like. But there's all kinds of inputs that are locking in, you know, a path dependency on a battery technology or on something else that we know is already being developed to another level, like with the labs or the national labs and other developments like that, that the cost should be less than what you think it is. And if you can put that energy transition cost into the the recovery models that we have, the regulated utility models that we have, or some of the availability models that we have on other projects, it should keep the costs lower than what you would otherwise expect. So we think there's going to be lots of renewable, solar, wind, bio, hydrogen is getting a ton of attention right now in the marketplace. Hydrogen's way off. It works well in a lab when the temperature is exactly 60 degrees F and there's humidity balance. But if you put that into the field, then it doesn't work. Carbon capture is the same way and things like that. So that stuff will continue to develop. There'll be advancements, and it'll reduce the overall cost of that. And it all fits into greenwashing, because even the dirtiest of the companies have some element of being better, cleaner, more efficient, and they want to be able to market that to their investors, their lenders, and their stakeholders.
Great. I'm going to skip over to regulatory environment next. We'll come back to public-private, because I think our questions are kind of now focusing on that, and I want to be responsive to what our audience wants to hear. So the question we had here is if infrastructure is an attractive asset class for insurers, how can regulators facilitate closing the infrastructure gap? What steps have regulators already taken, and are there initiatives underway? And I'm going to weave into that. I'm going to read the two questions that are kind of in that, in case you want to address them while you're answering. One is, do regulators have blind spots when it comes to infrastructure investment? And the other one is, should regulatory policy and capital requirements encourage infrastructure investment, which is kind of what's supposed in that question, for the public good, or remain agnostic and not pick winners and losers? So why don't we start with you, Mark?
Okay. Sure.
Now you're an expert.
So I'm chair of an ACLI working group that's working with the NAIC in terms of trying to facilitate, see whether there are economically viable ways to increase insurance investment in infrastructure. So we've had a good bit of experience with these questions, and so I think how we're trying to approach it is very much as Jim mentioned in the past, using the economics to drive the decision making, rather than saying, okay, we're going to have a public good aspect of this, and we're going to do this because it is morally the right thing to do. Right? So what we've seen on the regulatory side in terms of advocating for or facilitating insurance investment is really a focus on the capital requirements for infrastructure investments. And we saw that first in Europe several years ago. European regulators insurance regulators created a separate required capital factors for infrastructure investment that were lower than other corporate credit. And they did that really because the investment risk, as we've discussed previously, is lower for infrastructure assets. And so that was the economic facilitation for that. So we've been working with the NAIC, industry has been working with the NAIC in order to see whether we can, what's the most efficient way in the US to achieve a similar goal. I think the NAIC has done a great job getting that process started. Director Fox mentioned a study that was published by the NAIC in September 2021 on the infrastructure gap that was very helpful in a couple of ways. It put a lot of great information out there in terms of where insurance or investment are invested, where the gaps are, even the concentration in energy and power investments, and threw out some ideas out there about how to facilitate more investment and accessibility. I think that what the other extremely helpful thing about that study is it sent a signal to industry that we're ready to engage on this issue, right? And for us in industry, we're always looking to see what the regulatory signals are, and if they're ready to engage, that's great. Then it's up to us to organize and engage on the issue, which is why we created the ACLI working group to do just that. So we looked at the European model in terms of creating a separate category of RBC factors for infrastructure assets. Now the problem is in the U.S., our recent history suggests that is a very long and winding road. So as many of you were probably involved with the effort that the NAIC embarked on about 10 or 12 years ago to refresh RBC factors for generic bond categories. And that process ended up with I think what everyone agrees is an excellent result. The problem is that process took 10 years, right? So in terms of doing a cost-benefit analysis with that recent history, in terms of whether should we do a separate RBC factors for infrastructure, I think neither regulators nor industry were prepared to say, okay, let's embark on another 10-year effort to do it, to do it that way.
To study the study?
Yeah. But very fortunately, there is a second way to achieve that same objective in a much more efficient manner. And that's leveraging a unique capability that the NAIC has, which is they have a securities valuation office with a team of credit analysts who are able to model credit designations for selected asset classes, right? And so, as we've talked about, if the investment risk for insurance companies is generally lower for infrastructure assets, and the NAIC recognizes that, then in that modeling effort, that lower investment risk should be reflected, which, sorry about the circuitous path here, but lower investment risk means that the credit designation that comes out should be relatively favorable. And when that credit designation is then mapped to a capital requirement, the capital requirement should be generally lower. And assuming that chain of events happens, then that would bring infrastructure assets back on the efficient frontier for insurance investment. So what we did is we engaged with the NAIC to ask whether they would consider doing credit designation modeling for infrastructure assets to achieve that objective. And we had two very positive surprises on that score. The first one was that the NAIC SVO was very willing to engage on that topic, and they had the expertise was in-house in order to kind of achieve that objective. That was number one. We were happy with that. But the surprise on top of that, which was really unexpected, was that a significant amount of work has already been done. So with your leave, I'll go take a little bit about a backstory about why that happened. So approximately 10 or 12 years ago, renewables, that is wind and solar energy, was still a relatively new asset class. And I believe that there are some favorable tax advantages in the U.S. toward investing in that debt. And that made it an attractive asset class for insurers, particularly life insurers. The problem was that it was still a relatively new and untested technology at that point, which, and this was a long time ago, so Jim should not take offense. So it was a little bit problematic to get an effective credit rating on these assets at that time in their infancy, right? So a couple of insurance companies had come to the NAIC and said, would you be willing to provide a credit designation so that we can get an appropriate capital charge on this asset? And the NAIC was willing to do so. And so they went ahead and they performed, and they went through the process, and the insurance companies were happy with the process. And so what the NAIC did, or the SVO did, was that they took that experience and they actually built out the capability to model credit designations for the entire energy sector of infrastructure, which, as Director Fox mentioned, is a significant majority of outstanding investments. So a lot of the and this really was a surprise to many of us in industry. So the NAIC already has that capability to provide credit designations and kind of support the market in that way. Now again, this is a totally objective analysis, credit analysis. It's not facilitating things to be a public good. It's tried and true, boring, if I may say, methodologies.
Insurance likes boring, you know that, right?
Very objective kind of methodologies here. So we were, the real question at that point, and sorry for the long story here, from the NAIC is, okay, we have energy, what's the next sector that we should be looking at? And that's a great question to be asked, if you're in industry and you're trying to push things forward. And so we kind of agreed that the next sector that would be really helpful would be, transportation, right? So we're now in the process of kind of building out that capability, between industry and the NAIC. It's a very, I'd say it's a great partnership, great cooperative model, I think, between regulators and industry in terms of achieving an excellent objective.
Nice to hear about the SPO work and the CIPR and the usefulness of that
Right.
study, because I can tell you as regulators, one of the things we struggle with is there's so much information and there's so many things, and finding out what's valuable and what's out there and just hearing how you're using it, I think is really valuable to us. This is going to segue to a question we have here. It says, cities choose to invest in football stadiums over roads and bridges. Are we putting too much on industry to solve the problem of critical infrastructure? Jim, what's your perspective on that?
What's my perspective on that? Industry is well positioned to solve the problem of critical infrastructure needs. They need a partner with the government or whatever other organization could be part of that. I am very sympathetic to the fact that there's new football stadiums going up and it's not the bridges and the roads. And personally, I think that's an issue, although it's nice to go to those new stadiums once they're up and running. But industry is well positioned to handle this. The government is well positioned to handle this. And I don't know where the dividing lines will be between who wants to do what. Industry is going to want certain risk mitigants documented going in to do that. And you can, the more you want to structure it and paper it, the higher the upfront costs are, but the lower the risks are over the long-term period of time. But I would say that industry is very well positioned to make these investments.
Let's move on to resiliency issues. The national and global backlog of needed infrastructure improvements is enormous, and factors from extreme weather to political gridlock only seem to exacerbate the problem. Are we rowing against the tide? And whoever wrote that, I apologizes for that pun. And it is our sector playing a role beyond investor as proponent of mitigation resiliency to shrink the infrastructure gap as we build. And I'm going to turn this to you, Jean-Gabriel. What's your thought about that? In this whole mitigation and resiliency world.
So on that point, we can see that again from our business side, and my colleagues on the underwriting side are tackling with those issues. For the new project they can insure. I think we can, as insurers, we can certainly contribute through the risk consulting resources. So we have a big risk consulting teams, and for them to to work with clients and increase client awareness, better assess the risks, so that the cost of the infrastructure is decreased, and the resiliency can be increased.
So I'll just weave into that. Someone has asked, should the IIAS and standard setters create best practices around infrastructure investment? You're talking about the resources that you have, and to examine those, does that suggest that kind of that public-private between these standard setters and what you're doing? Does that seem like a good idea to you?
As we discussed in some areas, I think it's good to set standards and clear definitions, so that the industry can align and be more collaborative, I would say. It will take time, and it's not an easy task.
Do either of you have anything thought about whether there ought to be some attempt by IIS and other organizations to set standards on infrastructure investment? Or is that just kind of a fly in the ointment?
I think it depends, right? So we usually say things like more regulation is better, even if it hurts certain elements that are participating, because it rises the tide. So standardizing and creating a predictable and stable environment is what the capital markets needs the most. And it's the unexpected intervention that could really affect long-term, pricing and risk factors. But at the end of the day, most of the intervention that we've seen has been on the positive side. Okay. And somebody bumps into something, and then you come in and they fix it.
Yeah, I mean, I guess it's a question really of, are the existing economic incentives in the system working, or is there something where there are some externalities, whatever, in the system where you would need that a regulatory standard setting body? So I haven't really heard anything where it's like, we've identified gaps, we've identified reasons for those gaps, and I think we're making some progress on that. So,
and by focusing on the credit kind of aspect of it, that kind of is a standard in and of itself.
So while generally in favor of standard setting, I think there should be some kind of rationale for why it's needed in this particular sector.
Understood.
Sorry, just to add, I think also we need to consider the fact that the asset class is evolving very rapidly.
Yes.
Still a developing asset class, so against the timing for the standard setting process, correct, you need to make sure that you are not catching up.
That's a good point. Let me talk about public-private partnerships. That's very much in English, we butcher this, I'm sure, from your perspective, in vogue. They are here. The idea that in the insurance space, with the number of projects ongoing in the U.S., in the infrastructure space, it is a partnership, but it usually is some longer-term contracts that many consumers are used to seeing. Can you talk about this? how are we seeing it affect infrastructure as an asset class? Could more partnerships, public-private, facilitate increased insurer investment? Is it something that draws you to a particular project if you know there is this kind of collaboration? Have you seen its success, you know, in the PPP world? Let me start with you, Jim.
So we like public-private partnerships. Very busy, a lot of growth in that particular market. In the U.S. especially, it's happening. Overseas, it's harder, right? It's not a good vote getter in the UK to have that type of structure. And so we're seeing regional differences in it. But what I was just saying a little earlier, you know, when you have a good project and you can paper out and allocate who's got what risk and who's responsible for what, it's a much harder lift in the front end. But public-private partnerships, even though they're a smaller slice of the overall pie in our default studies, default's the least over a 10-year compound annual growth. The 10-year cumulative default rate is the lowest on the public-private partnership. And it's also, we have a cohort issue because it's a small number and things like that. But it is you know, really effective in how they can work through problems both on the construction side and on the operational side when they have a well-done project. Now, what we see is that it's the governmental entities that don't really have, they're the ones that are more along the lines of, this is a much bigger cost to do this up front, and so then let's do something less expensive. And so then, you know, that's where some of these challenges are.
Is there a difference between the, you know, more established European and U.S. markets and emerging markets when you talk about public-private partnerships?
Yes, and so on the emerging markets, we see them coming up, learning, but still much less experience on all aspects of it. Plus, you've got some of the higher social risks and governance risks associated with the emerging markets.
Jean-Gabriel, do you have a thought about this?
Maybe just one point which is also coming from our underwriting side, as they have seen some of those public-private partnerships. What they mentioned to me is that the long-term maintenance is an issue, and generally they see that as a hurdle to those projects to properly price and cover those long-term maintenance costs for the related infrastructures.
Martin?
Yeah, and I think just if you just look back at the theory of it, with insurance companies invested very heavily in the energy space, and I'm assuming if many of these public-private partnerships are not in the energy space, that would be a good diversifier for for insurance investors. It would lower the risk in the portfolio. And it would seem that the real roadblock to that would really be on the municipal side, on the public side of that, as opposed to kind of a lack of demand or potential demand on the insurance side. So that would I would think that, you know, on the whole, that would definitely more public-private partnerships would facilitate higher insurance investment.
So we have a question here. With movement toward international capital standards, will that impede the ability of jurisdiction and insurers to value infrastructure classes? Any thoughts?
I don't think it will impede investors to value, because, you know, valuing is about projecting cash flows and defining how the interest rate at which you discount those cash flows. But it can create some differences between different jurisdictions, related to the attractiveness of the asset class. So, as you mentioned, in Solvency II, you know, Europe has adopted a lower capital charge for infrastructure assets versus equities. It's also the case in Bermuda, in the local regime. I don't think it's the case yet in the US, so that can create some biases. And at AXA XL, we have carriers in all of those jurisdictions. So when we allocate to infrastructure, we would certainly consider, the amount of capital that we need to reserve.
Yeah, and I would almost turn that question on its head, because as we said, Europe was first in terms of creating this separate factors for required capital factors for infrastructure. My guess is that Bermuda's adoption of that, I'm guessing with the BMA head here in the audience, but could have been related to that in order to make it more consistent with Europe. We have Japan that's slated to adopt the same system in 2025, so they would also have the option, I believe, of adopting that methodology. So actually, as capital standards become more aligned globally, it may actually facilitate more of this type of incentives globally.
And Jim commented on the default rates. I think there is a good rationale to have a lower capital charge. We also have our internal model. So in our internal model, our risk team is analyzing a long history of data to set the charges. And in the internal model, the infrastructure are also much less charged than
to make an evidence-based call for a lower capital requirement.
Our default studies that I referenced are being used for that purpose with, certainly with some of like the World Banks, some of the multilateral development banks and whatnot. The argument is to do that, exactly that.
So the next question kind of bridges a lot of the discussion we've had over the last couple of days and now, yesterday and today. Can AI be used to help with the potential talent gap for evaluating these asset classes? What's the potential for using AI to evaluate infrastructure investment? Is that something that's being considered? Is that like out there? Is this an idea that has legs?
Well, not to be too flip about it, but when AI can get out in the field and dig a trench and put some foundations down and like lay bricks and things like that, it's going to be wonderful for the infrastructure needs.
So I think that's a no from you.
I think AI can help, with efficiency, right? So like, what is the most efficient way to apply the capital? What's the most efficient way to order the equipment? What's the most efficient way to line everything up? But at the end of the day, what we're focused on right now is that talent gap in the construction field. Like, where is that? And we look at Canada and we think that they're doing it better than maybe the US is, but we're really focusing on the need for the construction side right now.
Gentlemen?
Yes, I would totally agree. Maybe AI can bring a first layer and can help to be disciplined in your investments, but especially with infrastructure, there is a lot of engineering aspects, very complex. We discussed about various regulatory aspects, uncertainty about how those regulatory aspects will evolve. I think it's challenging for AI to capture all of that. So clearly, we'll need more skilled engineers and more education to help with the asset class.
So this is good for humans.
I think so.
Okay.
Yeah, I really agree with Jean-Gabriel on this one. You can kind of see a role for AI in terms of the portfolio optimization and basically saying, oh, at a high level, at a theoretical level, we think you should have X% of your portfolio invested in infrastructure assets. But when it gets down to the nitty-gritty and you're looking at trenches and things like that for individual projects, it's hard to see how AI adds a lot of value into that or a lot of credibility into the kind of the usual functional review that goes into these projects.
So a number of our participants here appear to be interested in asking you this. What about impact investing, for example, affordable housing? How can insurers be part of this solution? You want to tackle that, anyone? Mr. Expert?
That's energy.
Okay, well then how about you, Martin? Do you want to pass the ball? No. I mean, is that raising back to the issue of should we be looking at the type of investment as opposed to the value of the investment? Should we be looking at social good or credit good. Like, yes, it has a social aspect, but it's also sound investment policy.
Correct.
And so it's hard to talk a little bit about a particular goal unless you know what it does in terms of credit. Is that what I'm seeing from your reluctance to dive into this?
A little bit. Clearly, there's a ton of housing stock that is needed. So can you direct the investment in to make that happen? You could. I don't know why we still have these deficiencies in what the housing stock is right now, especially when it comes to some of the affordable housing issues that are out there. You can't. I think it goes back to the returns that you were talking about earlier. If you can get the return in there and the risk-adjusted return, then I think then you should see the capital start moving in that direction. I don't know where the connection falls apart, whether it's on the return side or the risk side.
I know we're 40 seconds over, but I'm going to let just this one last thing go because we're here. Because there were a couple folks who just want to, this should be a pretty simple question for you. Would municipal bonds count as infrastructure?
Depends on the use of proceeds.
Yeah, I would say you have two categories. You have the general obligations bond that I would not count against infrastructure, but you have the revenue-based bonds, which are linked to specific projects, and those I think should count.
So I love that answer, final. It depends. Oh, that's perfect. Well, thank you so much to our very knowledgeable panelists, and thank you all for so many questions here. I think that really made the discussion so much more valuable, and we really appreciate the opportunity to be here with you today.
Thank you.
Thank you.